When a company goes public, headlines often say it raises billions overnight. But an IPO isn't just about new money. It's a carefully structured financial process that changes how a company operates forever. Today, we break down how IPOs actually work. IPO stands for Initial Public Offering. It's the moment a private company sells shares to the public for the first time. After an IPO, the company's stock trades on a public exchange like the NYSE or Nasdaq. In 2024, Nasdaq alone welcomed 171 IPOs, while across all U.S. exchanges a total of 225 companies went public, highlighting a strong year for domestic equity offerings. Nasdaq maintained leadership with strong activity across sectors, including tech and health. Companies go public for several reasons. The most common is access to capital. Selling shares allows a company to raise large amounts of money. IPOs also provide liquidity for early investors, founders, and employees who hold private shares. In 2025, the U.S. IPO market continued its rebound, with hundreds of offerings and many raising significant proceeds. CoreWeave raised roughly $1.5 billion, and Medline's IPO climbed about $6.3 billion, marking one of the year's largest offerings. This helped push total IPO proceeds higher, even as broader market volatility lingered. Before going public, companies hire investment banks, known as underwriters. Banks like Goldman Sachs, Morgan Stanley, or Bank of America help value the company, structure the deal, and sell shares to institutional investors. In return, banks typically earn fees equal to 5 to 7% of the money raised. The IPO price is not chosen randomly. Banks analyze revenue, growth rates, profitability, and comparable public companies. The goal is to price shares high enough to raise capital, but low enough to attract strong demand on the first day of trading. Market conditions matter too. In the first half of 2025, the aggregate amount offered in U.S. IPOs jumped over 80% year over year, indicating that pricing and investor demand helped fuel revived issuance. Before shares are sold, executives go on a roadshow. They present the company to large investors, explaining the business model, financials, and growth strategy. Investor feedback during this period often determines the final IPO price. On IPO day, shares begin trading publicly. If demand is strong, the stock price may rise above the IPO price, known as a first-day pop. However, this does not mean the company received extra money from that increase. That benefit accrues to public shareholders after the IPO. Most IPO shares are allocated to institutional investors, not retail traders. By the time the stock opens for public trading, much of the demand has already been filled. This is why everyday investors often buy shares at higher prices. After an IPO, insiders are usually restricted from selling shares for about 180 days. This lockup period prevents early investors from flooding the market with stock immediately after going public. IPOs can be volatile. New public companies often lack long-term earnings history, and expectations can be unrealistic. Some IPOs outperform, while others lag. For example, many large offerings in 2025 saw mixed post-listing returns across sectors. This mixed performance underscores that a strong debut does not guarantee long-term gains. An IPO is not an exit, it's a transition. Companies trade private flexibility for public scrutiny, regulation, and constant investor pressure. Success depends on execution long after the first trading day. Global IPO statistics also show evolving market dynamics. By late 2025, there were over 300 IPOs in the U.S. alone, reflecting a more active primary market than recent years, with total listings significantly higher than in 2024. Analysts see this as part of a broader recovery trend across global capital markets. This is the real business today. If you want clear, data-driven explanations of how markets and companies really work, subscribe.